Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It is Monday. That means it's Macro Monday. Content schedule update alert. Setup Sundays, Macro Mondays. Teaching Tech Tuesdays. What could go wrong? Wednesdays, that's going to be alts. And then some more stuff probably coming Thursday, Friday. I usually have a pod with Ledger, obviously. So I thought I'd start to talk about this stuff more because I'm always looking at it anyway. And I certainly have opinions. So why not bring it out? For those who don't know, I asked ChatGPT, what is macro, right? Macro is a lot of stuff. Most of us already aware, very much aware, affects you directly. Employment or unemployment, inflation, GDP, monetary policy, fiscal policy, rates, etc., etc., etc. Tons of stuff, in my mind, fit under the macro umbrella. So let's talk about it. We'll start with inflation. We have CPI, which is the government-released data that's often lagging by up to 6 months, potentially, on the housing data side of things. And then we have trueflation, which is a sort of a real-time estimate. Now, it doesn't have the same exact calculation basket as CPI, but it's close, and it's been dead on the money, as far as I'm concerned, in the leading department. So currently sitting at lows. And depending on where you sit on this, you like CPI, you think it's great, you like core, you like super core, you like PCE, whatever it is. It's data, it's statistics. People can use the data to justify just about anything. The general idea is that you want rates above CPI, interest rates, in order to bring CPI down. And we've certainly brought rates above CPI. They were a little late on raising rates. By little, I mean very late. They waited until CPI was, I think, 6 to 7%. They were on this whole transitory bandwagon. In any event, we got there eventually slowly. The next print is in a few weeks. And, if you want, you can tease apart this data and see all of the various inputs here. And why this is so important, inflation specifically, is because if you're on the inflation is headed in the right direction on a year-over-year basis, we should hold rates here or cut, versus every other central bank in the world who's continued to raise or paused and then raised because inflation is still a problem. One other thing I have to do is make a new Twitter list for macro people. There are a lot of really, really great macro accounts. This is one of them that really keep you up to speed on just the global data set as well. So look for that in the next few days here when I have some time to put that together as well. Because there's a lot of stuff. Every week there's always, most of the time, in my opinion, right, Bitcoin's been around 10 years. No one's cared about the Fed, inflation, realistically. No one's cared about most of these numbers, realistically. The reason why macro side of things has become more important is because of inflation, because of debt, because of rates being the highest they've been in 30, 40 years. So if you're unfamiliar with this stuff and you're trading on the crypto side of things, it's definitely useful to have some knowledge at the very least as to what's going on. There's been a lot of chatter about government debt, housing, banks, right? So I'll hit on all of that as we go along here, but housing specifically, there's two minds. Housing is great, housing is fine, housing is healthy, housing is well capitalized. And then there's this other subset where, depending on where you're at regionally in the country of the United States, your housing market on the western side, California, Phoenix, is a disaster fire. In the Sun Belt, in the Midwest, in Florida, Texas, maybe a little bit better, maybe not. In Austin, right? Some of these places got extremely overheated. But there are some early troubling signs of things to come in the housing market and commercial real estate, right? This is all part of the conversation. And one of the interesting things, this is from Realtor.com, is that rents dropped for the first time since COVID. I think some of the data from Redfin and a few others also agreeing with that data, that rents are coming down. So that's eventually going to have an effect on CPI, which is majorly lagging relative to where it gets fed into the data. So if you have some sense of where the data is going, you can try to play this game of, okay, I think I know what the Fed's going to do, right? The reason that's important is because that seems to have a massive effect on markets, obviously. Another part of CPI would be cars, new cars, used cars. I think used cars specifically is a line item in the allocation percentage there. But again, seeing some interesting data points as far as, cars sitting on lots. We're seeing Tesla repurchase prices fall considerably. And this is the used vehicle index from Manheim. And if you're a Head and Shoulders enjoyer, just based on technicals, this thing looks like it should continue to drop. But this was one of the early data points for inflation rising so rapidly. So if we continue to see this decline rapidly, again, that would feed into this narrative that year-over-year inflation has come down considerably. And you can see a trend line here where the used car index is likely to return should all things be normal here. And like I said already, if you're one of the non-CPI enjoyers, if you're a super core person, this is a Paul Krugman article from New York Times, but he's arguing, let's take out food, shelter, energy, used cars. That's fine, but what's left at that point? Food and shelter seem pretty important based on just living and being a person. But this has also come down. This is the super core, come down quite a bit on a 6-month basis. So all that sort of data point gets fed into these meeting probabilities for the Fed and their interest rate decisions. On the left here, you see the dates that the Fed is meeting to make these decisions. You may have heard of Alan Greenspan or Volcker or whoever else, right? But never in my lifetime have I ever paid attention to what Fed chairs were saying as much as I have in the past 6-12 months, right? And these blue highlights are where the market probabilities sit on the current day. So we are currently pricing in a hike, a 25 basis point hike. Now, I would read this as one more hike. That's what the markets are pricing in. Some people would read this as 3 more hikes, depends on how you want to think of it, but I'm just one meeting at a time here. The interesting thing about this, if you look at like historical probabilities versus actual meetings, they tend to be a lot of the time sort of opposite. Shocker, I know, but when rates were low, probabilities kept suggesting they're going to hike, they're going to hike, they're going to hike. They never did. Right now, the probabilities are suggesting rates are high, they're going to cut, we're going to hold, right? So I wouldn't read this as this is what they're going to do, at least not until like the week before the meeting. But it's just interesting to get a gauge of market sentiment. And you can see we have no meeting in August. We don't have a meeting every month. That's also worth noting here. And where that is tradable or felt on the FX and rates, exchange rate side of things is DXY, the US dollar index relative to other world currencies, mainly the euro, also Canadian currency, JPY, that sort of thing. And this is where it all sort of comes together because you're looking at the DXY as an inverse to anything that's priced in USD, essentially. At least that's how it's worked for Bitcoin, for crypto. All of 2022, extreme bull rally in the DXY, parabolic in nature, arguably. That has cooled off considerably. And, NASDAQ has had its best year on record. Bitcoin's up 70, 80%, whatever it is. Tech's doing really well as DXY cooled off. Arguably, this is trendless according to the cloud. It could lean bullish or get bullish if it's above this diagonal here. I didn't draw out like a descending triangle, but it kind of fits a descending triangle. It kind of fits a triple bottom. This may be as neutral as you'll see anything generally, because it kind of, is in between a bunch of chart patterns, but definitely worth applying TA to this and using that as a data point to make decisions on risk. So if the DXY pops off again, I'd expect risk markets to have a harder time moving up, right? I'll say it like that. And if the DXY starts crushing lows below 100, back toward 90, then risk markets are probably all-time highs. Bitcoin's at 6 figures, right? That sort of thing. And it will be interesting how this looks into Bitcoin's halving relative to rates, obviously, if rates come down or not. Something else that's been on everyone's radar, at least, the flavor of the week thing. 2 weeks ago, I think, or whenever it was the debt ceiling. This week is probably going to be Russia and geopolitical stuff. But this is the Treasury General account. When people say TGA, that's what they mean. And the government's bank account was getting dangerously close to zero without the ability to issue new debt. So in raising the debt ceiling, we allowed the government to issue new debt, and you can see money flowing back into TGA here. And the question was, where is this potentially $1 trillion, right? They like to be around 500 billion, I think was the number historically. Maybe in recent times, somewhere up here, 3 to 6 billion, let's say. But they do have a target in mind. And the question was, where is that going to come from? Is it going to come from the risk markets, where you're going to have people moving from risk into bonds, or are you going to have that coming from the reverse repo facility, which is already money that's on the sidelines, not participating in risk, right? So far, we are seeing a good chunk of the reverse repo move into bonds by the looks of it. I'm not going to explain the reverse repo in this video. I'll do that separately at a separate time. But again, it's another data point. We couldn't raise debt. Now we're raising money. Where's that money going to come from? There's a lot of money in the stock market risk, obviously, at least with the S&P. And if you're looking to go risk off into bonds or something like that, definitely attractive rates at this point in time. And like I briefly mentioned already, another data point often cited recently is bank deposits. This is a regional banking ETF. And if you're awake on planet Earth right now and you've got money in the bank, you probably have it in a money market or a high yield savings account, ideally somewhere at 5% or higher. And that's taking money out of banks, hitting banks that are smaller, the hardest regional banks. And we obviously already saw a bunch of banks blow up earlier this year. Yellen saying last week, I think, that she expects more of those mergers in the future. And one way to bring all that data together is, let's look at this ETF and what does the TA tell me based on the cloud. On the daily, there is a potential for some sort of inverted head and shoulders situation here, definitely. And it's going to be very interesting to see if we go for this edge-to-edge trade, right? We're going to watch it live, but 40 to 50 would be the trade, and that would likely mean that banks are doing well again, these regional banks. I don't think that's highly likely based on the fundamentals, but I could be extremely wrong on that. One thing to watch for on the cloud here would be a bearish TK cross with price below cloud. That would likely mean new lower lows on this, and that would likely coincide with more regional banking failures. So definitely something to watch here the rest of the year. And the other, maybe this was last week's flavor of the week macro discussion, was the breadth of the S&P 500. So the S&P 500 is 500 highest market cap stocks in the United States. And I believe this is the largest percentage the top 5 have had, right? Bad breath is what the kind of theme has been. FANG, Tesla, NVIDIA, whatever, right? However you want to think about that. The Elite 8, whatever you want to call it. Most of the gains, right? All the gains arguably have only been in those 7 to 8 stocks. We haven't really seen that today at the time of this video, but leading up until today, they'd all been doing extremely well. Something else that's been interesting is there's been a lot of options activity. This is chip stocks, average daily call volume at an all-time high. So there's definitely a lot of activity on your NVIDIAs, your AMDs, that sort of thing. Still, moving on to the more technical side of things, we've got the S&P, which continues to look bullish, but probably overbought at this point in time. It had this ascending triangle and or inverted head and shoulders bottomy type of pattern ready to make higher highs. Eventually it did. Sentiment was extremely bearish, was sure we're going to hit a recession, hard landing, right? That didn't quite happen yet. And now we've got everybody, to me at least, seemingly flipping their sentiment. The bull market's back, baby. We're 20% off the bottom, whatever it is. And I'm saying, I don't know. I mean, I wouldn't want to be going heavily long when the S&P looks like this. Personally, I think we're probably due for some heavy ranging here, potentially a new higher high on a bullish divergence, but I am not at this point expecting much more to come unless the Fed starts cutting, which is extremely unlikely. So I may be a macro LARPer, but the TA here is looking pretty rough for the S&P. If we're talking about the S&P, I want to talk about the volatility index, the VIX, fear and greed index as it's known. And the VIX is quite low. You can see, this is 08, the VIX spiked. This is COVID, right? We're talking skies falling crisis. Complacent's probably the wrong word, but definitely has a historic range that it fits in between. At some point in time in the 80s or 90s, I forget when, they changed the formula for this. So it's not exactly 1-to-1 historically, but in any event, the VIX is quite low still. And when you pair this with sentiment, again, interesting that when we were ranging so heavily, there was a lot of bearish sentiment and maybe people preparing for that, and it never came. And now you have people maybe preparing for bullish continuation and the VIX at lows, and that might not come, right? So we'll see. I'm not really a VIX trader, it's just something interesting to watch. An interesting note, though, on top of that, is that historically the VIX has also played a role in Bitcoin's price because it affects risk markets generally. That's the sentiment gauge. So during the VIX spikes, we have seen bearish downward volatility in Bitcoin, definitely. Gold is also a part of this conversation. It's another sort of risk off bucket in my mind. This is a 3-day chart. It doesn't move quickly at all. It certainly looks more bullish than neutral on TA, right? But, you're not going to have anybody talking about this relative to, the gold bugs are going to talk about it and think it's the next best thing to slice bread, right? Constantly. But again, sentiment was extremely bullish at these highs. It looked like it wanted to move to a new all-time high. Didn't quite get there. So I don't have a great read on this other than it probably moves up eventually, but, it's ranging at the moment. Now to just quickly look at those Elite 8 or Top 7, however you want to think about that, FANG stuff from a TA lens. This is Tesla. The first thing that popped out to me on Tesla, I hadn't looked at this chart in a little while, but first thing that popped out to me was definitely this, sickle sigh, right? The Grim Reaper's tool, toucan, whatever you want to call it. Very familiar with this type of thing in crypto. And I think seeing this on Tesla is a reminder that, the same people are trading Tesla that are trading crypto, right? It's mostly retail, at least it was. So that's far in the rear view now, but interesting to see that play out like it did, right? Just absolute digging. Year to date, it's up quite a bit. We're above the daily cloud. I like 215 based on the Kijun here. So it does like a pretty decent pullback. You can see when price gets far away from the blue line here, the Tenkan, that's also a very good signal for being overbought, being oversold. This is 1852, 104.26, by the way, for the cloud. And another thing that popped out to me was the bear div here on volume. You're getting a higher high on less volume. Now, the div purists probably would disagree with me, but not something that I'm looking at thinking, I want to be long here, right? I would much rather look for lows on Tesla for sure. Interesting though, on the weekly, back above or inside of the weekly cloud again, to me, this trade is done. We'll see what it looks like in the coming weeks, but I would expect this to just grind out in the cloud over continuation here. It doesn't quite look like it did in 2020 just yet. So I think this one's got some time for sure. NVIDIA is one I actually traded 235 to 413, which was a monster of a trade. This is 2022 now. You can see again, we had a trend channel here. We had an inverted head and shoulders. We had a cloud breakout. All these same TA principles certainly apply. Reconsolidated at the inverted head and shoulders target and then made some sort of rising channel, I guess you'd call it. And now we've built in this massive gap between 318 and 367 with the cloud liking 360 thereabouts as a pullback. I think this thing's way overbought. I think there's divs all over it. Can it go to 800? Sure, but it's going to do that without me, definitely. So I don't even know if I like this thing at 360. But if you're just trading the cloud, that's where the cloud likes it. I know I opened the video with a ChatGPT query, but I think this is a little bit overheated. Meta to me looks like kind of like a fake chart because it's just so orderly. It's such an orderly decline, such an orderly move up. Maybe this is just how Meta gets allocated into, it's orderly allocations of 401ks or whatever. But again, this still bullish. Okay, great. 250, I like as a level. I don't like rising on declining volume, right? It's another divs all over this. I know I'm just coming in here raining on the bull parade, but I just don't see great reasons for mega continuation just yet without a pullback on most of these charts. Google actively pulling back now. Falling wedge, very possible. 115, that's probably too high as far as where this could go. Lower, it could even go to 109, somewhere there for that neckline retest. But interesting how these charts are reminiscent of, Bitcoin here, Bitcoin on the way down, right? The massive head and shoulders, just very interesting how this stuff sort of looks the same. So I like lows for Google there, Microsoft as well. Again, just continued volume lower on higher highs. It's never a great recipe for extended bullish continuation. You've also got a bear div arguably on RSI there, and I like 314 based on the cloud. And lastly, Apple continues to look okay, but again, working on some sort of div up here, and nothing typically goes, straight up at a 45-degree angle. So I don't have a great read on this one other than it certainly would look better with a pullback towards a high time frame moving average, right? If you put the 200-day moving average on here, it's probably somewhere around 160. So I think a lot of this stuff just needs to relax for a little bit. So I went a little long on the macro vid this week. Will be shorter in the weeks to come. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.